If you're tired of failing prop firm challenges, then you need to get your risk management in order. In this video, I'm going to run you through the risk management protocol that you can apply to your trading to pass more challenges and, most importantly, get more payouts. Now, by following these steps, you're going to become much more efficient in managing risk, much more efficient in terms of getting your results, and ultimately earn more money from managing prop firm accounts. Now, before we get into that, I want to remind you that we're currently running a giveaway here at Prop Firm Match for your chance to win a free challenge account. So make sure you stick around to later on in the video where I'm going to explain how you can win that. For now, let's get into it. Now, one of the most common things I'm asked when it comes to risk is people asking things such as, what lot size should I use? What risk return ratio should I be looking for of my trade? Should it be 2 to 1, 3 to 1, 5 to 1? What's going to make me a better trader? Now, the answer is neither of those things. The reality is it doesn't really matter. It's relevant to the strategy that you're using. Let me explain. So when it comes to lot sizes that you're using, that's going to vary depending on the size of your stop. You see, you're not always going to have a 20 pip stop loss, 30 pip stop loss, 40 pip stop loss, or whatever it may be. You're going to have a stop loss that is going to go in the place where your idea is no longer valid. So that might be below a low or above a high, for example. Now, that low or high is going to be a different distance from the entry that you're using on each trade. So therefore, the stop loss size is going to be different, and therefore the lot size is going to be different. Do not use the same lot size on all of these trades, otherwise your risk per trade is going to be completely different. Now, a similar situation also happens when it comes to the risk reward that you're using on each trade. If you always set yourself a 3 to 1 target, sometimes it's going to be hit, sometimes it's never going to get there. Realistically, your target should be set for a reason, in the same way that your stops are set for a reason. This may mean that you're targeting the next level of resistance on a particular setup where you're getting long euro dollar. Now, that's also going to vary each trade. Sometimes it might be 50 pips, 100 pips, 200 pips maybe. So never ever select a set risk per trade in terms of a risk to reward ratio. Let the market dictate, and you'll have more consistency in actually hitting those targets rather than sometimes falling short and the market reversing against you. Now, once you have that in order, what you then need to do is be consistent with the percentage of your capital that you're risking on each trade. You see, every single prop firm that you trade with is going to have daily drawdown limits and also max drawdown limits before you fail that account. Now, what you need to do is make sure that the risk that you're using on a per trade basis isn't going to massively take you over either one of those drawdown limits and straight away blow the account. Now, this goes hand in hand with the strategy backtest that you should have already conducted before taking on a prop firm challenge. Now, when you do a backtest, I'm not just talking of 50 trades or something like that. I'm talking about hundreds and hundreds, if not thousands of trades that you've gone through and backtested. Firstly, you'll actually know that that strategy is of course profitable, but you'll also know what a realistic number of trades in a row that you could lose is using that strategy. If you have a 60% win rate, for example, having a 10 trade losing streak is probability wise anyway, very realistic when actually putting that into the market. You can almost guarantee that that is going to happen at some point if you use that strategy for long enough. So now, being armed with that information, you're able to work out, well, how much risk per trade should I be using? If you have an 8% drawdown limit, for example, on that account, and you know that 10 losing trades in a row is statistically possible, you shouldn't be risking 1% per trade or 2% per trade. You should be using closer to 0.5% per trade. Because now, if you run into that bad patch where the market just doesn't agree with your strategy for a period of time, you're not going to blow up that account, either in the challenge account stage or once you've been funded and end up losing that account. So it's incredibly important that the risk strategy that you're using and applying to your account is relevant to the strategy that you're using, both in terms of risk per trade, the lot sizes that you're using, and also the type of risk to reward that you're looking for out of each trade. So now that we understand what you should be doing before you execute the position, now I want to talk about risk management during a trade. You see, a mentor of mine years ago taught me about the concept of evolving R, and essentially how risk changes as a trade is running. So what I mean by that is, imagine that we had a trade that had a 20 pip stop loss and a 60 pip target. So we was looking for a potential trade and a 3 to 1 return on that position. Now, if that trade's running very nicely, maybe it's 50 pips up, so about 2.5 to 1 up on that position, but in 20 minutes time we have NFP results coming out, which obviously, typically speaking, is a very volatile event. Now, essentially what we have on that position now is evolved risk or evolved R, by where we're now giving up or potentially giving up that 50 pips if the news goes against us, all just to gain an extra 10. that there is completely out of sync with what you want to be doing as a trader. You've essentially got a negative R return going into that event. So realistically, what you should be doing at that point, most likely, is just closing that trade, banking the profit, letting the market do what it wants to do during that high impact news event, and then coming back the next time a strategy rule is met and a potential trade is setting up. Now, apart from the obvious when it comes to risk management, one of the biggest impacts of having the correct risk management in place is actually going to be on your psychological and emotional control. You see, when you're not on top of your risk, what ends up happening is you end up in a situation where it becomes very, very easy to find yourself in a high stress environment where you've either got far too much exposure, trades going against you, things like that, but also it then leads you down a path of looking to try and chase those returns. So what you want to make sure you're doing is keeping on top of your risk as a priority, not just for individual trades and the sake of just managing drawdowns, but then the ripple effect that it then has on everything else. Taking control of your psychological elements and also the emotional elements that are obviously a key pillar when it comes to trading the markets. Now, the final point that I want to make here, guys, when it comes to risk management is overexposure across the actual account. Now, what I'm talking about here is lots of people look at risk very one-dimensionally, basically, and they only look at it on a per trade basis. So you might have a position, for example, in euro dollar, you've got a position in pound dollar, and you've also got a position in dollar yen. Now, whilst they're three individual trades, and you might only have 0.5% risk per trade, for example, you've also got three lots of exposure to the US dollar. So if we get something that happens, or just a general market sentiment shift that creates a movement in the dollar, you haven't just got 0.5% worth of risk, you've got 1.5% worth of risk, because all of those trades are going to move in the same direction, and ideally, obviously in your favor, but most of the time it's going to be sod's law that they run against you. So you need to make sure that you're aware of risk, not on an individual trade basis, but also on an overall account basis as well. Now, if you follow those risk tips, guys, you're going to have much more success and consistency, not only in just passing the accounts, but also, and very, very importantly, getting payouts and making money and an actual ROI return off of your investment for buying the accounts in the first place, because at the end of the day, that's what we're all here to do, is make money. Now, as I said earlier on, we've obviously got the giveaway that we're running right now, and I'm going to explain to you how you can enter that for your chance to win. So first things first, you need to obviously make sure you like this video and of course subscribe to the Prop Firm Match YouTube channel. Now, in the comments below, I also then need you to answer the following question, and we will announce the winner in the comments of the next video. So comment below the answer to the following. What was the general guide that I gave earlier on when it comes to managing risk on a per trade basis? Is that 0% to 1% per trade, or 5% to 10% per trade? Answer in the comments below and we'll reveal the winner in the next video.